All right, everybody, Leo Cannell here. Today's Seven Figures Club podcast, we've got an incredible guest, an entrepreneur who has had multiple exits. He's going to be talking about exit strategies. He's also someone heavily involved in the capital raising and has different capital raising firms we're going to talk to. So today's guest, my friends, is Shepard. And he has generated a lot of attention for entrepreneurs, investors around the world. He's passionate about utilizing his talents, which are many, to acquire skills for the betterment of society. Greg has acted as a chairman for congressional candidates. He's a dedicated philanthropist for science, human rights, special needs children, and environmental causes. He coined the phrase altruistic capitalism in a Forbes article, of which he's published many articles with Forbes. And he has this belief that you can use the advantages of capitalism for altruistic purposes to make the world a better place. Obviously, he's an entrepreneur, 20-year startup veteran, serial entrepreneur with 14 liquidity events. A lot of us out there are looking for, that first one or two liquidity events. Well, Greg's done it 14 times. He's done it in diverse industries like biotech, transit tech, ad tech, martech. Two of which were sold actually as part of a $925 million transaction, nearly $1 billion. It won 4 PE awards for transactions between $250 million up to $1 billion. He's an author, a Forbes books author. He has a brand new book that'll be coming out later this year that he's going to tell us a little bit about. He's got over 100 articles published in 25 national publications, international as well. Fortune and Entrepreneur, U.S. News and World Report. He's obviously an investor, and he's the founder of Boss Capital Partners and a Boss Capital Science project that he's going to talk to us a little bit more today. And for a lot of you out there who are looking for kind of that next capital partnership, Greg's going to talk to us a little bit about what it takes to qualify and get the opportunity to work with he and his team. Greg, welcome to the podcast. Excited to have you on.
There are over 32 million businesses in the U.S., and over 90% of them will never break 7 figures in annual sales. So how do we as entrepreneurs or aspiring entrepreneurs break into that 7 figures club? This podcast will relentlessly share the secrets, strategies, and tactics I've used to create 3 multi-7 figures businesses and bring in even more successful entrepreneurs than me to share their inspirational stories and tactics to success. You can create your dream business and life right now. So buckle up and let's go.
Thank you. I really appreciate it. Thank you very much.
And
what a mouthful to introduce, huh? Thank you.
Well, I mean, you've accomplished a lot. So I just wanted everybody to know, I like everyone to know at the beginning of a podcast, hey, this is someone you're going to want to listen to and learn a lot from. And so I guess the first thing that kind of comes to my mind that I wanted to talk to you a little bit about, as you look at some of those exits you had and maybe that first really big exit or two, what were some of the strategies that you employed? And do you feel like you were doing things differently to actually obtain and hit that first exit event that maybe before in your career you weren't doing? Or was it a matter of it was all this process and journey step by step, you couldn't have gotten to where you're at? What was that like? Just tell us a little bit about it.
It's a really good question, actually. I mean, so when I started, the first exits, every time I built a company, I kept meticulous notes on the process. So what did I do? And I would debrief myself at the end of every month on what went wrong, what went bad, what could I do better, what would I do differently? And so I went through this process and I kept all these notes, and that's basically what the book is, right? So I created this thing called BOSS, which stands for the Business Operating Support System, because essentially I wanted to create an operating system. Initially, it was just for myself so that I could do businesses faster. So I could, start a business and sell it faster and do more than one at the same time. And I got to the point where I could do 3 or 4 at the same time, and I could sell them in 3 years from the data. One I sold in 1.5 years. And these are nice exits. So I can tell you, like, when I get on podcasts, one of the things I really try to make sure that the entrepreneurs understand is that it's really, really, really important that you start with the end in mind. And what I mean by that is If you're out there and you're starting a company and you're taking investment capital, you're not building a lifestyle company. What that means is you have to sell your company in order for the investors in you to get your capital out of it, right? Otherwise, it's just a sitting capital asset. It's not liquid. And so it doesn't help you. And what that means is that you have to start where you want to end. And what I mean by that is, if you're building a business, acquisitions of companies happen from larger companies. Those larger companies grow through acquisition. They very seldomly build their own stuff, right? They go out there and look for things to buy. Now, why do they go out there and look for things to buy? Because those companies have absorbed the customer acquisition cost, what we call a CAC, right? The cost of acquiring customers. They've done that. And they may have 100,000 customers, 20,000 customers, whatever it is. And they've already paid for the cost of those customers. So where they make money is on the lifetime value. When they've sold their services to those customers, the CAC to LTV ratio, so the customer acquisition cost to lifetime value ratio, flatlines. So what do they have to do? Grow the LTV. How do they do that? They buy other companies. So if you don't start by understanding who your acquirers are, then essentially you could be going the wrong route the entire time. And what I mean by that is, let's start with the customer that we were just talking about, the ideal customer profile that they have. Let's say that you've been building this business for 5 years. You get to the point you want to sell, and you've got the different customer than they have. You don't have a deal. So you just wasted 5 years and all that capital and steered off in the wrong direction. And that's just one example. Another example is when you look at opportunities, there are businesses that are built to save money and businesses that are built to make money. The businesses that are built to save money are solving a problem, and those are typically bear market businesses, right? When the market's not doing well, people are trying to save money. And then there are bull market businesses. When the market's doing well, people are making money, so exploiting an opportunity is, you have these two types of businesses. It doesn't mean that you have a business that you have to change your business or anything. You just change your narrative, right? So as an example, one of our portfolio companies before was a MarTech platform for realtors. And the whole strategy before COVID was sell more houses, make more money, blah, blah, blah. And after COVID, the narrative changed to, hey, consolidate all your platforms, save money, use one platform, right? So this is an example. And if you don't start with that when you first start building your business, then you can easily go off in the wrong direction. And the analogy I use for people is I say, listen, if I'm going to go from my house to your house and I don't know where you live, it's going to take me forever to get there. And the journey of building a business is like a navigation in your car or on your phone. You put in the address you're going, you put in where you are, and then the plan maps your direction to that location. But if you don't know where you're going, you're going to be wandering around for a long time trying to figure out where your destination is. And the destination is definitive. By the definition, what I mean by definitive, I mean by, comparing the analogy of, this customer wants to buy this product. And if you don't have that customer proven to buy your product, then that means that their customers won't buy your product and you don't have a transaction. Does that make sense to you?
Absolutely.
So that's like the first thing, right? When I tell people, I'm like, look, I've been doing this for 25 years and, all the stuff you read off. And I'm like, look, the first thing is what I call the North Star. Figure out, who you want to sell to. You need like 5 of those, what I call IAPs, ideal acquire profiles. You need like 5 of those. You need to make sure your ICP is the same as those guys. You need to make sure that their behavior patterns and acquisitions align. And you need to make sure that you don't overvalue your company. When I look at the reasons why entrepreneurs fail, so I studied this, right? I studied this for 5 years with a team of 5 people. 90% of entrepreneurs fail. So it's like, this is a problem, right? When do they fail? So the first 50% fail within 1 year of leaving an accelerator. The other 40% fail within 5 years after that. So you have win. And then why do they fail? And the biggest one is undercapitalization. So you have to ask, well, why didn't they get Why were they undercapitalized? The investors lost confidence. Well, why did the investors lose confidence? And then you start getting the truth. And these things all can be put aside if you have the correct alignment in the very beginning. If you think about what you're going to do, you know, think about you're going on a vacation. You don't just jump in your car and start driving, right? You have a plan of where you're going and when you're going to get there and where you're going to stay and all this kind of stuff. So that's the one thing along the lines of what you say. This is the thing that I have learned over and over again. And now with every portfolio company, it's the very first thing I do, and it is absolutely critical.
Unbelievable. So before even getting very far in your business, when you have an idea, a structure, and you're getting some of that seed capital and that proof of concept, begin with the end in mind. Figure out who do you want to be when you grow up this company in the next 2, 3, 4, 5 years. And more importantly, and I think this is a massive golden nugget, and I was listening to another entrepreneur like you who had multiple exits, and he did it similar to you, and where it wasn't just some investment firm or private equity that was looking to purchase, but it was actually someone who was in their field, that strategic buyer who, oh, great, this is the perfect addition, you know, to our offering with our client. It's going to increase that lifetime value. So how do I go about figuring out if I've got a product that fits with that larger potential strategic buyer? How do I know if I'm a fit for that big strategic buyer, so that I do it right from the beginning and I line everything I'm building to get to that strategic buyer?
Yeah. So first, you know, I tell people, I'm like, listen, you basically have two routes to acquisition, right? So one of them is a strategic, like you said, and a strategic is going to buy you to either enhance their existing offering, in other words, you know, sell to their current customers, or maybe you're going to save them some money. So it's the same thing, right? Either solve a problem, save money, or exploit an opportunity to make money in those scenarios. And I think that it's important when you think about this to start by, okay, so, you know, when you build a product, you don't build a product without having a customer, right? It's not, you don't just go, okay, I'm going to build a problem. You're not one of these companies running around with a solution looking for a problem, right? That's not a good way to start as an entrepreneur. So the same thing applies for the acquisition strategy. When you talk about starting with the end in mind, you wouldn't build a business without a buyer, just like you wouldn't build a product without a customer, because essentially your whole business is just a product to the buyer to sell to their customers, right? So you start out by saying, okay, what does this company offer? Who are their customers? What problems do they have to solve? The same scenario you would go through when you're creating your ideal customer profile and persona, you know, your buyer personas, you would do the same thing that you do there with your ideal acquirer profile. And you get like 5 of them, and you end up with 1 of them, right? But you groom the company for them. And what a lot of people don't understand, a lot of entrepreneurs don't understand, and they're always shocked when I tell them, because I don't usually get on the phone and do the deal for them. I like coach them through the process because I want them to learn it on their own and become a serial entrepreneur on their own. And so a lot of times I tell them, I'm like, listen, call the corporate development people at the place that you want to sell your business to and ask them, say, what are you guys looking to acquire? What are the holes you're looking to fill? What are the problems you're looking to solve? What is the minimum in ARR and annual recurring revenue we have to have in order to qualify? You ask them for their requirements, just like you would ask, if you're gathering requirements for building a tech stack, right? And you would be amazed at how many of them are like, yeah, you're going to build a company to solve a problem for me? That's fantastic. And then you go away, and 5 years later, you call them up and you say, hey, man, guess what? I built that thing that you talked about, and I've proven it, and I've got 100 customers exactly like yours, what we call in ICP customers that are exactly like yours, to prove that your customers will buy this product. That's how you do it. And it's the most critical thing. I mean, there's a lot of steps in BOSS. This is part of BOSS, the business operating support system that I talk about. That's the book, and BOSS Startup Science and all this stuff came out of this, that are built from, just my experience over 25 years. I started from nothing. I was working 4 jobs and eating mac and cheese and, squatting at hotel buffets for breakfast and stuff. I mean, it was rough, right? I had no money. And it was a really difficult process. And the reason why I do this whole thing is because 4% of people have the chance to do what I do, and 75% of them do it by starting a business, and 90% of those people fail. So I created Boss to prevent this from happening for other people. And that nugget that I just gave you at the very beginning, that is critical. If you're trying to cross the ocean and you're 1 degree off, you're going to end up in a different continent. That's building a business. So get your bearings, right? And you get your bearings by understanding what is the end game? What does success look like? What's the outcome and exit, right? And this also prevents a lot of other problems. Like one of the top 5 problems with businesses is what's called overvaluation. So most entrepreneurs will start out, and I have these calls all the time, and they'll say, okay, I'm a, Series seed company. That means that they have a customer, right? They have like $1 of revenue, something they've validated, what they're doing. And they go, okay, I got a $5 million valuation. And I say to them, do you realize that by saying you have a $5 million valuation, what you're saying is that you have to sell your business for $25 million right now? Because the investors want 2 to 5x return. So now you're like, okay, at $25 million, how much is your company actually going to be worth in 5 years? 50 million? I mean, anything over 50 million has a drastic drop off. So those of you that are listening that think you're going to do a unicorn, you have a better chance of being a rock star. So maybe just draw it down to 50 million, 25 million. So you can see how easy it is to get overvalued. And what happens is the investors stand back and they go, and they may let it slide up front, right? They may just let it slide, especially big VC funds with LPs, because it makes their portfolio look bigger, and they don't care if they lose money. They counted that into their risk management anyway, right? So the fact that 9 out of 10 fail, they don't care. They've already accounted for it. But you as an entrepreneur, that really matters, right? You got your life in the deal. You got your 401k, your house, your family. I mean, you can't afford to fail. So thinking about that valuation is critical, because you go to round 1, round 2, round 3, round 4, round 3, you're overvalued. Now nobody wants to fund you anymore at the most critical time, right? So now you end up going out of business. That's why 40% of them fail in the second half of that, right? After 1 year, you see 50% fail. Most of that is because they have bad advice. A lot of it comes from investors. Sorry, investors, brother and sister investors. That's it's true. And a lot of times because they just don't know the path. They've never done it before or whatever. But if you look at the reasons after that, it's overvaluation almost all the time. So if you start out with the end in mind and look, I'm going to be able to sell this company for 25 million, and be realistic, right? How much do you need? Really? I mean, come on, and guess what? You have to sell one to have another one. So start out small like I did. It's not about home runs, it's about base hits. So you start out, you do a little deal, you do a little bigger deal, you do a little bigger deal, and pretty soon you're funding your own stuff, and pretty soon you're funding other people's stuff. So the overvaluation is a massive threat to people, because they just don't get it, right? I mean, I probably look at, 100 deals a month. And it's probably 80% of the time I look at a deal and I get on the phone, I look at the deal, and they're like, Series seed, and they're like, yeah, it's 5 million. And I'm like, let's plan this out. All right. So you're going to do a round for $1 million. Now you're a $6 million post money deal, right? Now in a year, you're going to do another round for $2.5 million. And then you're going to do another deal, and you got to add 5x on top of that every single time. And what happens is, one of two things: either they don't fund you, or they do fund you, but they only fund you in order for you to grow to your valuation. So what happens is you raise money, you put it into growth, the valuation goes up. Now you have to raise money again, put it into growth, your valuation goes up, and you go around in circles until you're overvalued, right? And then you see all the losers now going IPO. It used to be that the winners went IPO, but now it's the losers that go IPO. Because the individual shareholder, like an average cat that's trading stocks, doesn't know what the venture capital community knows. So the IPO bails out the investors who bought into an overvalued deal. So, you see this like interchange, but all this stuff can be avoided if you just start by planning out the whole thing like you would anything else in life, right? It's just, I mean, this is like the event of your life. You're going to build a business is the event of your life, not sitting there going, okay, where am I going to be in 5 years? How much is my company going to be worth? And all of these things that boil it down are critical to making that happen.
Let's talk a little bit about the valuation formula, because there's a lot of confusion about how your valuation should be and what it should be calculated. Of course, it's different at the beginning when you're getting the first round or the second round of capital funding versus obviously when you're trying to get to that exit point. But a lot of the times, if you look, there's simple 3 or 4 times earnings. If it's an ARR situation, which I definitely want to ask you a little bit more about that, where you've got accounts, that annual recurring revenue that's coming in, that's super important in increasing your multiple. And obviously, if you have a strategic buyer, now that's generally, from my understanding, where you can get a much higher multiple.
Way better. Yeah.
And so that's why you want to do that from the very get-go, right?
Right. Because so if you're selling to a PE, you have to realize that PE needs to make money on your deal, which means they can't pay you top dollar. They can't. They have to pay you on a fire sale, meaning they have to pay you as little as they can because they're essentially arbitraging your deal, right? So you don't really want to sell to a private equity. You don't want to sell to a venture capital. All these people are just trying to make money on your money. So you're giving away part of your money to them. You want to sell to a strategic, which is why you have to plan. Now that goes back to your question about multiples, valuation, all that, right? So, when people look at businesses, there's these things called valuation drivers. A lot of these things that I'm talking about are things that I came up with that are in my book and whatever, right? But I call them valuation drivers because these are the things that pivot the valuation, and their growth, margin, and retention. Right. So growth says people like your product. Retention says people will continue to like your product, and margin says you can do it at scale. Now, if somebody's buying your company, they're going to be buying it on top line or bottom line, right? And if they're buying it on EBITDA, it means they're trying to fatten up their profit and loss. Now, it's very difficult to build a business with fat bottom line margins, right? It means you have to
grow.
Yeah, you're investing money and you're trying to squeeze and get bottom line. So EBITDA sales are very difficult to achieve, and a lot of people go out of business thinking that it's about profit. And on the other hand, top line sales are better, but then you have to think about growth. So if you understand the requirements of the company that's buying you, the strategic is buying you, and you sit there and you go, okay, you have growth, margin, and retention. Which one is the primary? Is growth the primary? And by growth, is that user growth or revenue growth, customer growth or revenue growth, right? And then margin, does margin matter? Well, probably not, because they're going to merge your company into their company anyway. They're going to tell you it matters, and it matters to understand the mechanics of your business. But to the buyer, they're going to dedupe everything out of the business. They're going to get rid of a lot of people, and the thing's going to have a lot more profit anyway. So it's kind of a, bullshit story, right? But if you really focus and you say, okay, top line, growth, margin, and retention, out of those 3 in a SaaS business, retention is king, right? Because retention means that month over month growth is easy to achieve because you're not it's not like you have a hole in the bag, right? You're adding revenue on and it's filling up the bucket. If you have churn, if you have the loss of customers, it's like filling up a bucket with sand and there's a little hole in the bottom and you're constantly, and that's expensive. It costs money. You raise money, you get dilution, you have a problem. So you focus on growth, margin, and retention as value drivers. In ICP is extremely important. These things have to be in ICP because if they're not, they'll just carve it out. They'll say 25% of your customers are not in our same customer category, in our same ideal customer profile. We're not going to pay you that money, but we'll give you your multiples over here in ICP revenue because they don't care about the other stuff, right? So making sure that you have that, and then understanding what are they trying to do? Are they trying to buy and benefit the balance sheet? Or are they trying to buy and benefit the P&L, right? So if they're benefiting the balance sheet, it means they're trying to grow a capital asset, right? They're trying to build a bigger company and they're trying to build a base and they're trying to have assets and stuff to build up for like a walled garden approach like you see Salesforce doing or Facebook doing, when Facebook bought LinkedIn, that was a perfect example of that. Or on the other scenario, are they buying you because they're looking to grow their top line revenue or their bottom line revenue for their own exit, right? If it's a smaller acquisition, unless the strategic is an end state strategic, somebody like Adobe or Google or whatever. But as an entrepreneur, it is the chances of you getting an exit to one of those giants is extremely slim. But the chances of you getting an exit to one of the people in that chain before that process is probable, right? So, again, go for the base hit. If sometimes entrepreneurs will call me and I'm like, okay, what's your exit strategy? 99% of they don't have one. And then I'm like, okay, well, as an investor, I'm interested in who's going to buy your company because that's how I'm going to get my money back. And they'll be like, Google. And I'll be like, that's like somebody saying, I've been to the United States. Where? What state? What city? What area? I mean, Google is a monstrosity. Amazon is a monstrosity. These companies, Adobe and Salesforce and on, they're massive. So you can't say Google. You have to say this particular group. They operate like individual companies. But even that is really difficult. To do an acquisition with a big company, just the acquisition part itself can take a year, and usually does take a year, 6 months to a year on average, right? But these little like $25, $50 million acquisitions, if you play your cards right and you do it along the way, you can get a deal like that done in 3 months. So, and then let them deal with the problem down the line. Remember, the clock is ticking, right? And the numbers say, if you're at the casino, the numbers say that the longer you go, the more probable the chances are that you're going to have some event, some failure event or something critical happen. And that could be a competitor. When you start your business, nobody knows that you have this great idea that's solving a big problem. You're the only one that knows, right? Otherwise, there would be somebody out there doing it. As soon as you start to get sales and pick up, then somebody knows. And that somebody now has the ability to just look at you, emulate what you're doing, and run up behind you. Like if you're hacking down a jungle, the first guy does all the work, the second guy just runs up right behind him. And this is what you see with just about look at MySpace and Facebook. And you can look at Apple and Microsoft. And you can, just go across the board to anybody, right? And you see this Google and Yahoo and on and on.
Instagram and Snapchat. Snapchat was coming on and Instagram's like, yeah, we'll do that better. And then they did. So.
Right. Yeah. And it's so easy, right, to look at what somebody else did and said, oh, I can do a better job, steal their people, whatever, and just 100%. Raise. Yeah. So, the clock is ticking. So plan your exit and then drive as fast as you can to that area, but very intelligently and logically understanding things like the valuation drivers and leading and lagging KPIs that are income or expense KPIs and things that allow you to sort of understand the performance of the company before the financials come out.
100%. Hey, Greg, now one of the keys to creating a company that you can exit, and this seems to be just so true now, and let me know if I'm on the right track, is creating an offering that is tied in to some sort of subscription, some sort of recurring revenue where you're adding customers and it's growing the top line because you have a recurring revenue subscription-based product or software as a service or what it might be. Mm-hmm. Is that one of the keys to building something that can exit at 8 figures in your opinion?
Absolutely. Like there's no question about it. So you have the route of doing a one-time sale, and every time you have to work just as hard. Yeah. And you have the route of doing a sale where you have recurring revenue, right? And that's MRR, monthly, or ARR, annual recurring revenue. And the idea of the SaaS model, this subscription, everything now you see is subscription. And basically the model is, everybody has so much money, so much disposable cash to spend in the retail, commerce side, or on the other side in the business, the same model, right? And if you do MMR, you've essentially locked up that little bit of the revenue that you're going to get out of that. If you don't, you're risking it for somebody else to go lock it up. And so doing something where you have a subscription model is like critical to getting a big exit. You don't see a lot of companies these days that don't have subscription models that have nice exits. The other thing is that you can clock retention, right? So you can say, let's say that you have a subscription model and predictability is a big driver to premium valuation. So to get a bigger valuation, having some ability to give the buyer a predictable revenue channel. And you go to them and you're like, look, I've got, 25,000 customers and every customer is paying me $100 a month. And my retention rate is 90%. So 90% of that $100,000 a month, 90,000 a month is safe revenue. That's valuable, right, to a buyer. Because not just because of the 90,000 a month, but because it tells them how their own customers are going to perform with your product, right? So it gives them some predictability, which then makes your valuation go up because now they're less scared, right? The less fearful they are of losing the money, the looser the purse strings are. Does that make sense?
Absolutely. And do you tend to think, obviously there's opportunity on each side, but do you tend to believe more in going after a B2B where it's kind of other businesses that are buying a product service that's in that recurring revenue model? Or do you like going after consumers, or is it just really depend on your industry? What are your thoughts if someone is looking at different ways to, all right, is my avatar, my perfect customer client going to be a consumer or a business? What are your thoughts?
Yeah, that's a good question. I think that, basically I see entrepreneurs, there's three different types of entrepreneurs. There is an entrepreneur that's a visionary, right? So this is an entrepreneur that just has an idea, right? And they just have this vision and they can do that. The second type is a subject matter expert. So these are the ones that I look for. And these are ones that are like, you're a consultant in an industry, you see a problem over and over and over, and nobody's doing anything about it. And you're like, why isn't anybody doing anything about it? And then you decide to do something about it. Those are the best ones, right? Because I look for opportunities, and you should as an entrepreneur, you look for something that's inch wide, mile deep, right? Inch wide means that not very many people see it. Mile deep means the opportunity is very deep. So everybody's sort of skipping over these inch wide ones and going out to the ones that are mile wide and inch deep. And the way that moves is that the competition narrows and widens the groove, right? Versus opportunity it makes it shallower. So basically it's as if you have this inch wide, mile deep channel, and then it starts getting stretched. And as it gets stretched, it gets shallower. That's an opportunity for something that is, people see all the time. And you look at a lot of MarTech and ad tech stuff now, and it's just like every day, another Zoom. Everybody wants to do a Zoom, educational platform, kids at home. COVID has inspired entrepreneurs, but they really need to step back and go, okay, how many tens of thousands of other people are doing this? Versus if you have a subject matter expert, they're like, look, I'm in an industry where, I sold one in January last year for 48 million that was in the transit space. So they were, it was buses and ferries and trains. And they created a platform to enable people to use their iPhone, Apple Pay, and just pay mechanically instead of have to go to a station and get a ticket and distract the driver. It also gave the bus drivers analytics. And this was a guy that worked in the industry, right? And it's not sexy, buses, right? And trains and things like that. But the company sold for 48 million at like 20 times top line revenue, right? So that's because he was solving a big problem that nobody else had solved. And we did the deal in 3 years. We sold the business in 3 years, right? So it didn't give an opportunity for anybody else to catch up with him. In fact, the two followers went out of business recently. So, that's a perfect example of, paying attention to this ticking, I think of it as like a fuse, and I'm like, okay.
Got to move it before that bomb goes off.
Yeah, game on, you know what I mean?
So thinking back to, as you were raising capital and with some of your first enterprises, what was, especially maybe the first time for someone who's looking to go out and raise capital and they've got that business plan and everything together, what was it that caught an investor's attention to take a chance on you before you'd had this history of exits and you landed that first big, capital raise?
I didn't. I bootstrapped. Yeah, I actually.
All right, I like it.
Yeah, I bootstrapped my first 5.
So you bootstrapped your first 5? No kidding.
Yeah, first 5 deals I bootstrapped all by myself. I worked. Well,
let's talk about that. I love talking about bootstrapping. So how in the world are you bootstrapping your first 5 companies? that you build? How is that process of, getting, bootstrapping? Is it based off of sales? Is it, savings? I mean, how did that process work for you?
I worked 4 jobs. I mean, I literally worked 4 jobs. One was to pay for my costs, and the other 3 were to pay for the cost of the business. And then after I sold my first one, then I had some money and I reinvested 50% of what because I was, you sit there and you say, you exit a business, you're like, what am I going to do? Go put it in the stock market into other businesses run by other people that you don't know? Or are you going to invest in yourself?
Control.
Yeah. You don't control the market, all this stuff, so I invest in myself, and the same thing with the deals that I invest in. I know the companies I'm investing in, I'm working with them every day, and I'm betting on myself. And so that's what I did. And I just kept doing it over and over and over again, until I got to the big ones, and when I got to the big ones, I decided, okay, I don't want to actually build the companies anymore. Instead, I want to help other people. And so I did the stint in politics, and that was a colossal nightmare. And so I decided, okay, instead of that, I'm not helping people here. I can't have impact. And then I learned about this 4%, of people that have the ability to get out of that line, and they do it through building businesses. It's basically windfall, and it's lottery, inheritance, build a business. And so I was like, build a business. I know how to do that. I can help everybody. I'll just show them what I did and all those notes I kept. And that's what created I started writing articles, and then it got a lot of attention. I started speaking at universities, and then the Forbes deal happened and stuff like that. So I did it because of the path that I went down, and I know that there are a lot of entrepreneurs out there like me, but the process, what I went through was very painful, and it took me a long time. If you are able to find an angel to help you, and remember, the money is less important than the knowledge that they bring with the investment, then you can cut that time down, right? And then you can do more deals in your lifetime. So maybe, I had one deal that took 17 years. I mean, that's like, that's what happens, when you don't, because it just takes forever. To do things. You can only grow. You're restricted by that. And that's because I didn't know how to raise capital, and I did it wrong. And I went and talked to people, and this is also earlier. You have to realize that VC and angels and all this stuff is not that old now, right? So comparatively speaking, so before it wasn't the same as it is now. There weren't accelerators and all this stuff.
Well, and there's so many online groups now of angel investor groups and different that are looking for seed capital opportunities. And yeah, it's definitely seemingly there's more opportunity, maybe a little simpler process. But I like what you pointed out here. When you initially got off the ground, you're bootstrapping. And I see that with a lot of entrepreneurs where they are bootstrapping for quite a while until either they exit or they get that big venture capital infusion to go to the next step. And maybe eventually,
I think everybody should start out by bootstrapping. I do, because when you're bootstrapping, you are proving to yourself, and you're also proving to investors that what you're doing is a good way for you to spend your time, and time is more important than money, right? We're only here for a certain amount of time. And so, if you're bootstrapping, it really makes you question the chances of success a lot more than if you're riding on somebody else's money. And if you can get yourself bootstrapped, and you can get to the point where you have a platform or whatever the product is, and you have just one customer, then you can raise money, and then the rest is going to be a lot easier. And the investors see that too, right? I look at that and I go, here's somebody starting a business, they have a house. You do your background and you look at it and you're like, okay, this person came from a $300,000 a year job, and now they're raising this capital, and you know to yourself that this person doesn't have any skin in the game except for their own time. And if that thing goes out of business, they just go get a job, their life goes fine, right? But as the investor, you lose your money that you've worked really hard for. Don't discredit that, right? So on the other side, if somebody bootstraps something and you can see that they've got some skin in the game and they've suffered a little bit, right? They've earned this. And then you're like, okay, this person's not going to give up, right? They're going to make it work. They're going to stay in the game. And that's really important. So I tell everybody, I'm like, you a lot of things come to me and I'm like, you need to go back and get this thing off the ground. And so, Boss Startup Science, the school that I'm putting together to teach people Boss, is a lot of it is for those people, right? So they can go and learn the stages, the life cycle of business, and all the stuff I'm talking about that if you're an entrepreneur, you don't know the smallest detail. I mean, you don't know that you're in a minefield, let alone that you're literally standing on a mine, right? And so the idea is to these communities and all these things, they allow people to tell war stories and things like these conversations, but there's no tactical prescriptive methodology that people can follow to make sure they're staying on the rails. And that was, that turned into my focus, because I just really want to help people, want to help people that, people have it tough, There's a lot of people out there that, we're both white dudes. Right there, it's easier for us, right? Like way easier. So, how do you help the rest of the people, just get to the level that we're at? Well, let's start out with teaching them what it looks like to build a business and how things work and what the methodologies are and the terminology and all these, some things that you just oversee. Sometimes I'm on the phone with an entrepreneur and I'm using terminology and they go, what does that mean? And I'm like, oh, I forgot him, So
yeah, it's a whole vocabulary that we learn, and it starts, with credit and finance and all these different things that our education system is just not teaching. And so I love that you're building a school out for entrepreneurs to give them that knowledge. And obviously, a massive benefit for any entrepreneur would be to be able to work with your team in this Boss Capital. So, what is it you look for when you're deciding whether to work with somebody, and how can somebody prepare themselves to qualify for the opportunity to work with you?
I look at the idea of, when I make an investment, I think of the horse and the jockey. And the jockey is the entrepreneur and the horse is the product, right? So you have to start out by saying, okay, well, the jockey has never ridden a horse before. So it doesn't matter if they have the best horse in the world. If they've never ridden a horse before, chances are they're going to jump on, they're going to fall off right away. So what I do is I look for entrepreneurs that understand that dynamic and are willing to get, some advice and be open and, that sort of thing, right? Arrogance there's just no place for arrogance in business, just at all, right? It's just, there's no place for it. And, you don't know what you know and you don't know what the other person knows. So the best thing is to listen, because even if you pick up one thing, it's better than nothing, right? And you're not paying attention if you're talking. So I look for entrepreneurs that, when I'm talking to them, they understand the value that the relationship is bringing to them, that they're open to changes and, to developing as an entrepreneur. I look for people that are, smart. There's intelligence and then there's wisdom. And so you can get a really, really, really smart person, and sometimes they're a little arrogant, but they don't have the wisdom. They have to understand the difference between the two. A really smart person can lose to somebody who's not even close as, in terms of intelligence, just because the other person's been down that road before. So it's really important that they're humble. It's really important that they're capable of listening and that they're organized and they have good time management skills, right? I think that's really critical, and that they have the best intentions, right? So, if somebody builds a business and they think they're building the business because they want to make money, that's an outcome. That's not the journey. The journey is solving a problem that you see in the industry or exploring an opportunity. That's what you want to. That's what you want to focus on. The money is an outcome of that, of the success of that. That understanding is really important.
Absolutely. So you're looking for people who, have the great horse. They've got to have an amazing product. As a jockey, it's not like their first time. They have skin in the game. They've maybe tried something a time or two, didn't work. They're pivoting. They're trying to figure it out. And then they're not just focused 100% on, the outcome. I'm going to become a wealthy entrepreneur. It's, I've got a valuable product that solves people's problems, and I kind of have this amazing mission that I'm focused on. And if they kind of have those focuses, then they've got a shot at working with you and your team.
Yeah, like the one I was telling you about with the transit business. This guy was trying to right a wrong, right? He was like sitting here going, look, all these people that don't have very much money are riding a bus. And in order to ride the bus, they have to walk to a terminal, buy a ticket to get on the bus, right? And he's like, these people are just trying to get to work. They already have a hard life, and he was trying to right a wrong. That's the right motivation. The guy ended up making a lot of money.
It's a global business. That's what's amazing when you can come up with that type of solution. Like that's a global thing now that every single bus station in the world now can benefit from.
Yeah, and they are. Like it's literally in Sydney, it's in London, it's the company that bought them is the largest transportation company on the planet. And it changed. It was definitely a disruptor. It changed everything. And it's just this, a couple of guys that put their 401k, mortgaged their house, got their business going. Got a proof of concept out, had just had one customer. I invested, got involved. We sold the company, and now they're investors for me, with me. So, it's awesome.
That's what it's about, dude. That gives me chills just listening. Two guys that went all in, they mortgaged their house, put their 401k up. But that's what it's about because you've got something that you believe in. And 100%. Wow, I'm actually surprised because sometimes you get this idea of, venture capital entrepreneurs, they just go out and they don't take the risk, but they get the venture capital. But from what you're saying, a lot of those are on their second, third, fourth business, and they started out bootstrapping. They did put everything to risk. And that's how I've kind of always seen entrepreneurs. So it's kind of exciting to see that that's actually been the process that you've seen succeed. And now you're perpetuating it by bringing in other entrepreneurs and helping them make it possible. And it sounds like they did exactly what you did. You guys targeted, all right, here's the biggest transportation in the company in the world. This is an asset they don't have, but my goodness, they would love to have it. And just really, really a brilliant process that you put together. So where should we send everybody? Where should we send them so that they can learn from you and potentially, work with Boss Capital Partners? What's this process and how can they take action?
So there's 3 websites. I know this is ridiculous.
Okay, perfect. What's website number 1?
There's GregoryShepard.com. That's my website. Okay, so if you want to learn about the stuff I'm doing, that's that website.
And let me just say, guys, sign up, put your email in there to get Boss News events and his book release. I signed up. I'm excited because he has that book that is coming out in just a few months.
And then if you're looking for investment capital, bosscapitalpartners.com. That's the firm for that. And then if you're interested in learning about Boss and going to the academy and all of that, then it's bossstartupscience.com. I call it a startup. I call it a science.
I'm going to type that in right now. Boss Startup Science. Awesome.
Yeah.
Okay. Boss Startup Science, Boss Capital Partners. So if you're kind of in the process and you're trying to build that foundation, then Boss Startup Science. If you're trying to learn more and maybe you're kind of an aspiring entrepreneur, maybe going to Gregory Shepard, and that's shepard.com. Sign up for his book. And then if you're ready to roll and you're listening and you're implementing what Greg's talking about and you've got skin in the game and you're ready for that capital infusion to take the next step, then bosscapitalpartners.com is where you want to head.
And there's a ton in there. I spend a tremendous amount of time and energy doing videos and articles and things constantly. And, if you connect in LinkedIn or whatever too, you'll see it. But the best thing to do is to opt in for the email because you get like things that aren't in the social media and stuff and a ton of stuff. And I'm going to be giving a lot of books away to people when they roll out in June. So.
Amazing stuff, man. Well, we are excited. I'm excited to have you as a resource because with our we kind of have a debt funding marketplace to help business owners kind of just get some of that small startup capital, 15,000 to 75,000.
We didn't talk about that. That's a good route, and we should have talked about that. Sorry.
Oh yeah, no, we'll definitely talk about it after here. We can jump on, but yeah, I mean so we help them to kind of get that debt funding and understand a home equity line of credit or to get a loan off of a 401k to bootstrap and get going. But then for them to take that next step, that's where Boss Capital Partners really comes in. And so we will see that, that select group of people that come in, and now we've got a place to send them, because it's hard to find a really, good place that not only, because you pointed out the capital is one thing, but the actual know-how and the expertise to build that exitable business is significantly more.
Yeah, one piece of advice could either burn $100,000 of that investor's money or make $100,000, right? So the advice is really important.
100%. Well, awesome, amazing value. So those are the best places to connect up with Mr. Gregory Shepard, award-winning entrepreneur, 14-time exit strategist, and someone who's making the world a better place. And that's what entrepreneurs, my friends, do. Hope you guys have enjoyed this podcast. Greg, the last word or wisdom that we can all focus on to make 2021 our breakthrough year.
Kindness. That's it.
Amen.
Yeah.
Amen. You guys hear about it. Gary Vaynerchuk talks a lot about it, and it's not surprising. I'm telling you, some of the best people in the world are entrepreneurs because they care. Yeah,
totally.
Well, thank you so much, Greg. We'll get this sent out to the platforms and look forward to working with you. Again, that's bosscapitalpartners.com, gregoryshepard.com, and the bostonstartupscience.com for the information. And that's what it takes to succeed in entrepreneurship.
Are you looking for more seven-figure secrets, content, or even how you can launch your own recession-proof business? Then check out sevenfigures.com. That's the digit 7, FIGURES.com, where we share more videos, stories, strategies, funding solutions, entrepreneurial education, and even the secret business type that's recession-proof. Thank you for listening, and if you're finding value in our podcast, please give us a 5-star and invite others to join the club.